Thank you for joining us this afternoon. So we're going to have a panel now hosted by Faye on updating the GP selection criteria. Pleased to have Raina and Nina join us. William, unfortunately, couldn't stay until the end, but I'll hand over to you, Faye.
Thank you, Matt. So, good afternoon and welcome to this panel, which is focusing on the criteria which LPs use for selecting their GP fund investors. My name is Faye Margot. I'm CEO of Brackendale Consulting, which focuses on investor marketing and communication support for private equity funds globally. So this panel is going to be exploring what exactly LPs are looking for in a fund manager. While some elements are pretty obvious, others are less so. And as you know, GPs can often be left in the dark as to the reasons why an LP hasn't invested. So hopefully this panel will be shedding some light on some of the reasons why. I don't know if any of you have seen Private Equity International's recent fundraising reports, but as you all know, fundraising is pretty tough out there. It's very competitive. Private Equity International cited that in this year alone, the first 6 months, apparently capital invested in private equity funds has dropped by 27% compared to the same period last year. There's also been a significant 40% drop in the number of funds closed in the first half of this year compared to last year. All this has left many GPs wondering what exactly they can be doing to stand out from the crowd for the right reasons, that is, and ultimately how to secure investments in their fund. I'm lucky to have 2 LP investors with me on this panel. We have Nina Kraus on my left, Principal of Fund Investments at Hamilton Lane, and my far left, we've got Raina Effinger, Managing Director at Nord Holding. So let's keep this session as interactive as possible. We're not many yet in the audience. Hopefully more will be joining us soon. There'll be time for your questions and feel free to chip in on the panel. But I thought we could start by taking a look at how LPs keep tabs on viable investment opportunities. Nina, what does Hamilton Lane do to keep track of potential fund investment opportunities?
Well, we have invested quite a bit in technology. I think today with the number of distinct fund investment opportunities, but also secondary opportunities, co-investment, transaction opportunities, you really have to leverage technology to keep track of it, to market map. And that's not only on the CRM and deal log side, that's actually tracking information that you're gaining through due diligence, tracking the portfolios that you have, and then looking at the investment landscape as an opportunity cost. Every decision you make has an opportunity cost associated with not making every other decision you could. And so take this last year, we saw over 1,200 distinct fund investment opportunities. And when we think about co-investments and secondaries, that volume is actually outpacing the level of fund investment opportunities. And so the only way to do this today is with technology. And so I think you'll see the LP universe continue to emphasize the digital, continue to track, and continue to invest in that.
How's your team embraced the whole technology concept? I know when we had our call, you mentioned you had a sort of power users seminar internally to sort of brief everyone on managing the whole technology side of things.
We do. So we've been investing in technology for a few decades now. It's been a huge strategic push for us, and you have to build a culture around that, which we've really focused on. People are trained. People use the technology. We have power users. We highlight individuals building new technology solutions for our firm. And so it's really an element of our culture that now we cannot live without. But just to have technology isn't good enough. You have to use it. You have to respect it. And then you have to have the feedback loop to decision making, or it's not a valuable
you mentioned
cost.
It's not just technology, it's a human element as well.
It is, yes.
How does your team sort of involve that within the technology?
Yeah, I mean, look, you can go everything from testing on technology to, which is a bit more, I guess, a negative incentive to make sure you have a minimum bar, but you can also highlight people who are building new solutions. And I mean, that is really something key. We have something called the Innovator Award. And this is for people who've built new technology solutions to help our clients in a way that is differential from a time spent decision-making perspective. This makes it exciting to explore, exciting to get creative, and it really pushes the entire team into utilizing technology. I mean, power users, you have to do it, but it can't just be a few people. It has to be the whole firm, otherwise the data quality is too low.
Thank you. Rainer, what's your stance on technology and your use of it to track investments?
So I think, first of all, obviously every fund of fund today, I would guess, has a kind of technology to follow up and potential investments. I think in our case, it's maybe a bit less important as we are a very small team, as we are focusing on first-time funds, anchoring first-time funds. So I would say the networking and the coverage element of somebody responsible for a region is core for us to generate deal flow and to generate opportunities, at least in the primary segment. So it's important to track. It's also important when you have some fluctuation in the team. But I would say the most important thing for us to find investment opportunities, especially on the primary side, is being on the ground and traveling.
And do you find, since, I know we touched on this in our pre-panel call, but obviously during the pandemic, a lot of people relied almost exclusively on video calls. How have you found, and some people have not gone back to that. How have you found that?
So it's good that we are not based on an island. So also during Corona, there were some options to travel. If you were willing to take a car sometimes, if you are willing to break one or two rules, maybe sometimes. So at least there were options. During pandemic, I mean, yes, you could travel less, you could fly less, but it was still possible to do something. And the problem, I think, with the video calls is it's good element to follow existing relations. It's good element to optimize your travel schedule, but it's very difficult to build up new relations, to develop, let's say, creative ideas with a manager, to carve out assets, make a continuation vehicle where you never invested in. That's quite difficult, I would say. And I mean, typically, we also want to visit portfolio companies before we invest. So you need to have the ability to travel and to meet, to do things like that. So from that perspective, Corona was difficult because we could not do this as we would like to do it.
Thank you. How about yourself, Nina? You've said you've adopted more of a hybrid approach now.
I mean, the way I think about it is why limit ourselves to one mode of relationship building? I think whilst we didn't leverage Zoom and virtual ways of relationship building pre-COVID, I mean, now we have the option to fly around the world without any carbon emissions, basically, on a relative basis. And we have the option to travel and build relationships in person. And so I think what we're doing now is really taking that hybrid approach and making sure we're not losing the local touch, the in-person communication, because I completely agree with Rainer. There is something that cannot be replaced in terms of that communication, but we've also layered upon that a lot of virtual communication. And I think utilizing every tool in the toolkit is increasingly important as we think about moving forward and decision making, with more opportunities out there for everybody, and also more entrants into the LP market. I mean, there are new entrants even in a time like today where there is a bit of a denominator effect in some situations. There are still many LPs out there without private markets or without private equity allocations. And so to access those LPs, I think utilizing digital technology, Zoom, phone calls more to add to what you're already doing in person is going to be really helpful for GPs.
Encouraging note. So obviously now we've covered how LPs can track viable investment opportunities. What are the key criteria you look at when you found a potential investee fund, and how might these criteria have changed, say, compared to 5 years ago? Lena?
So I can take that first. I mean, the core criteria of diligencing a fund hasn't shifted dramatically. But I think as the industry has matured, LPs have gotten more experienced at diligencing those same aspects from a team and organization perspective, from a strategy perspective, and a track record perspective. But what I do think has changed is threefold. One is some topics have gotten a lot more press and focus that should, in I think many people's opinions, should have had focus, such as ESG and diversity, equity, and inclusion over the last couple of years. I think there are a couple of areas that are getting more focus today because of the macro headwinds, namely the financing market and operational resources to drive out performance in a much tougher market environment. And I think finally, digitalization. This is a big long-term theme for our asset class. And that's something that I do think LPs will continue to focus on as it relates to their GPs.
Okay, thank you. Rainer, you obviously focus on first-time funds, so your selection criteria is slightly different probably to Nina's. Can you share thoughts on what you look out for in a potential investee fund?
Yes. So, I mean, one of the reasons why we do first-time funds is that we think our industry in Europe is developing a bit towards what we have in the US, so which means more focused strategies, more narrow strategies. And we're trying to support this by not investing too much in generalist funds. And I would say, so I don't know what is the real statistic behind it, because obviously everybody would say, oh, I'm not a generalist. Obviously we have sector focus, we do IT, we do healthcare, we do whatever, and then some others not. But really narrow focused strategies are still not that common in Europe, and we are trying to support operational teams which focus on a topic and which are good in a topic, and so that's one of the reasons why we do these first-time funds. The other thing I think which changed in the last 3, 4, 5 years is we trying to overcome the blind pool risk, especially for the first-time funds. So we need assets at day one, assets with more than a normal potential which you find in a deal, because this obviously compensates a bit the problem of the first-time situation. So these are, I would say, the main things, and then there are, let's say, in the cycle you always have like different developments. So for example, we did quite a lot of continuation vehicles, also to try to capitalize a bit on the low entry multiples which we had in the portfolio and which we could realize by rolling them over. So this is a bit over now, and so I would say in the moment we are focusing a bit more on the turnaround side, because we expect that there must be a wave coming which is attractive in the segment.
Nina alluded to ESG and diversity and inclusion. There's a lot of talk about that at the moment. How easy is that for first-time funds, and therefore how much of an important issue is that for you when you evaluate potential opportunities?
I think this is something which is obviously today important for everybody to be implemented, but obviously, I don't know, a 50 million fund has less resources to do this. And obviously, it's also not set. I mean, I must say, I was a bit upset also during this conference to speak with some people who want to implement an Article 9 fund. And it's pure greenwashing, in my opinion, what they are doing. So I think this has to be further developed. Yes, we set criteria also for first-time funds that they implement things. But what we don't want to do, we don't want to support this tendency of trying to attract money and give money to things which are not, let's say, impact-oriented, but who would just claim to be.
There's a lot of that going around at the moment, isn't there? There's a lot of greenwashing going on. I think you even mentioned in our call there was a healthcare fund that claimed to be an Article 9 fund just because it specialised in healthcare.
Yeah, or somebody who says, I made a made in France or made in Germany fund. So just because they are supporting production and labor market in their local geography, I mean, every small cap fund typically has a made in something. I mean, that's ridiculous, sorry.
Have you seen examples of greenwashing, I'm sure, in your time, Nina?
Yeah, I think with the focus on ESG and, one step further to sustainability and then one step further to impact, undoubtedly now you have a very large spectrum of different definitions, different takes on what that means. And so I think as we look at GPs and also across our client base to work with our specialized mandates to fit different opportunities in, you really have to be aware of what you're trying to achieve, aware of how you fit in, and really define it. I think from a greenwashing perspective, the challenge is the definitions and then how that fits into the regulatory environment. And we all have to be really, really honest. And there's no easy fix from a diligence perspective. You just have to spend the time and the effort to take a view, to build your own definitions, and then to invest with those that are matching that. And so I think there's a lot of room for that part of the ecosystem to evolve. But there's a regulatory framework, and that really has to be complied with.
Good. We've mentioned operational capabilities as important. What sort of operational strengths do you both look out for in a fund manager? Rainer, maybe?
So typically, today, if you would look into a mid-market fund, more or less, they all have operating partner. If you take a closer look into what is the share of the carry they receive, you will be surprised it's still relatively low. Quite often, they are incentivized on the portfolio level. So they are still, in most cases, not really 100% integrated into the structure. So quite often, or typically when we invest in a new team, you have really from day one somebody with PE and somebody with operational background. This is what we like, to give more emphasis on developing the portfolio. That's also the reason why we like to have more concentrated portfolio. We don't like this 10 portfolio companies funds, because we make the diversification ourselves. We like more people who really concentrate on developing something. And you cannot make too many deals when you really want to change something in the companies.
Thank you. Nina, what about yourself?
Well, there are a lot of models out there that work. And so I think for us, when we're looking at operational capabilities, it's about the model and whether it fits with the strategy. If you're doing heavy operational work, typically we are seeing operators within the team. But if there are specific projects that are very, very specialist, sometimes it's better to have people outside of the team that you're bringing in. It really depends situationally. I think the one piece that should be on everyone's mind, it's very much on our mind. I sound a bit perhaps like a broken record, but it's the digital capabilities. We live in a digital world. Getting digital right is going to be important for every single business. And that's an area that I think actually there is a lot of room to grow when I look across the operational capabilities within the private markets.
Interesting. And how do you source we've looked at how you source your opportunities, but how do you reference and ensure that the fund manager is the right one to make an investment in? What do you do to make sure they do tick all the boxes that we've just said?
It's a lot of hard work. I mean, it's starting early, building relationships. Also, I think for everybody having a degree of empathy, right? Everyone's on a journey. LPs are on a journey with their own portfolios. GPs are on journeys, and you need to be able to contribute to that in a positive way. And I think that's where you start getting interesting answers, having good conversations about where capabilities really are. But I think also the off-book referencing, I mean, spending time in the industry, talking to market participants, and working with general partners on multiple opportunities across multiple different strategies. I mean, we've heard from Reiner about continuation funds. That's a completely different perspective on a GP than looking at a straight primary, and looking at a more traditional co-investment might be another touch point that you can have that gives you a bit more around the edges to build out your overall view.
Can you talk us through some of the industry participants that you might speak to, the different types of industry players when referencing a GP?
Yeah, so I mean, everyone on the reference list, but the off-book, I mean, look, we've all been in PE for decades at a certain point, and when we think about the market, I mean, expect lawyers, consultants, levers from your firm to be taking views, and I think actually it's really positive because they also are your best brand builders. And so whilst you may think, okay, the referencing is something that we need to build and curate a perfect list, actually everyone is being referenced every day, all the time anyway. And so I would just expect anyone that you work with or come across to be on that informal list, taking a view. But actually I find it always more positive than not. And by actually speaking to your references, if you're a GP in the audience, speak to everyone, ask them for feedback, and they'll likely give you some great views that exist out there in the market that LPs may come across in their own referencing, and that you can attack head on in a fundraise cycle.
Some good tips there. Rainer, how do you make sure your fund managers possess the qualities you're looking for?
Reference is important. The problem sometimes with referencing is that good managers not always get best references because they are not always the nicest guys. That's a bit of a problem. I would even say some of the best managers are really assholes. Sorry. But the most important thing...
Can I interrupt? How much of a factor
I don't give
an
an example right now.
No, I'm not going to ask you to name. No. I was just going to say, how much of a factor does that play, the human factor? If a fund's got an amazing track record.
In theory, we all think you need to have a balanced structure with a broad team, and the carry split should be fair and equal. In reality, the best performing funds which we have super heavy carry. Some guys take 70% of the carry. You say, ooh, that's not balanced, but he's good. So
it's interesting.
So theory and practical structure are sometimes a bit different. Concerning the selection, I would say the most important thing for us is always investments they have done. So visiting the portfolio companies, speaking with the portfolio CEO, CFOs, that's the most important thing in our referencing, beside typically following due diligence processes and actual investments, because there you can learn most about how they want to create value, how they want to develop portfolio, how they see the management. I mean, maybe it's we are too much into this because so I'm coming myself from the direct side. I did 15 buyouts, so I'm interested in how they want to develop the portfolio company. But that's the most important thing for us.
It's interesting what you say about the carry structure, and what are your views on that, Nina, in terms of if they've maybe not got the fairest setup internally in terms of fees and carry, but is the track record the most important aspect? Or
I think you need it. It's not only about that, and so I think, I mean, that's what Reiner is saying. There's a full picture of other factors that you need to consider. So I think having hard and fast rules, and you know, there are some out there, but a lot of the hard and fast rules are built from data. And so you learn over time where the point is at which something is unsustainable. But there are a lot of different sustainable models for different structures and different groups out there. But the data is key, and looking at it over the long term, you build those views on where the limit is. But I would say there's no hard and fast rule really across anything apart from perhaps if you're going after a really tricky track record. And then that's I would say, almost always going to be a very large focus of an LP selection process. But actually, all things being equal, it really is case by case.
Okay, we've taken a good look now at sort of the different criteria that you do look at when you're selecting a fund. I'm keen now to flip the question on its head and look at maybe what you don't look for, as in the things that can go wrong when you've been, say, tracking a fund that could be a good potential investment, and then something goes terribly wrong. What are the sorts of, without giving out names or divulging specific cases, what are the types of things that could go wrong? Like, say, a pitch. How important is the pitch if the numbers are good? Can you give some examples of things that can go wrong? You're smiling, Rainer. Have you got something specific?
Yes, because, you know, so often we have really poor pitches. So people which are not prepared to fundraise, which is in a way good, because it's much better than you have a group which with a placement agent and everything is like already set to be sold. So it's much better if you have a team who has done 2-3 deal by deal things and they have no real idea how to raise a fund, how to structure a fund. Because then you get an honest picture into it. Sometimes you have to maybe take 2 or 3 steps, which you typically would not take. But if you invest the time, you at least understand a bit more the dynamic behind it.
Do you prefer the honest picture?
Yeah, sure, sure.
Can sometimes it be a bit too polished if they've been too prepped beforehand, and you'd rather see maybe...
I mean, it's all polished, and if you look into the track record of the unrealized, they are all, let's say, quite often you have to think about if you are invested to sell it, because obviously performance is always good before fundraising and it's going down after fundraising. But let's say in general, I would say, so it's good if you have a manager who is not really 100% into the pure fundraising mode and supported by somebody who is making the deck for them.
Okay. Nina?
Yeah, I mean, I think the one hard line is around governance. I mean, there are funds out there that do not want LP governance, and that is very challenging for LPs. That's a big one. That's for us something that we wouldn't be able to do. I think in other cases, you know, we're not as focused, just like Reiner, on the pitch. We see all variations, but I think for us, if we take a really sky-high view on where things can go wrong, it's around self-awareness, on the answers of why something is the way it is, or how something is happening and what the purpose is. And those for us, if those aren't there, and we ask the questions very, very directly, and so try to get honest answers, and we are very open with what we're seeing and what the data is telling us and how our view of the market is. But if there's a really big disconnect still, it's very clear that it's not going to be a partnership that works. And that doesn't mean that it won't be a great opportunity for others. Maybe they'll take a different perspective, have a different market view. But I think for us, that piece of and the connectivity that creates, the alignment of seeing things in a very similar way, or being able to have the discussion about what the difference is if we have a difference of opinion. I mean, that if that's not there, it sets up a long-term relationship in a very, very challenging way. And so for multi-fund relationships, you would think very hard if that's not there to continue moving forward.
Okay, thank you. We've still got some time, but just wondered if anyone had a question from the audience, or yes. Oh, great. Hang on, do you want my microphone? Do you want to introduce yourself and say who you are?
Hi, James Hochter with Intelligence. I'm a journalist, so just to give you a heads up. I'm just wondering, given the current market environment, is there any particular private market strategies that you're seeking that may perform well, and how difficult are they to source at present?
Thank you.
I mean, obviously, everybody would be a bit reluctant in the moment to invest in too much industrials, energy, all these kind. Also, obviously, inflation, at least you could expect consumer-related topics to be a bit difficult going forward. But on the other side, honestly, I mean, if we look into the last 10 years of our industry, the share of industrial transactions, the share of consumer-focused transactions decreased a lot. So I would say the fundamentals are still the same. Maybe the risk is if people are thinking the whole world exists only into investing into healthcare deals, because this was on top of the mind for the last 2 years with Corona, and now it's continuing. Maybe at one point the public money will not be there that more to support healthcare companies. So, and the focus will be directed into something different. So just following the trend, which is there, maybe is also dangerous. But in general, doing long-term business, you should not depend too much on cycles. So I think this is something which most of the PE investors, LPs, GPs are following. And this remains also in this cycle, however the cycle will be. I mean, at the end, I'm pretty sure that the winter will not be that cold, at least at home. And so if something is going into a wrong direction, a new problem will occur, we are not aware of it today. So,
Nina, any sectors you wanted to flag?
Look, I mean, our client base and our strategy is very broad, but at the end of the day, these relationships and these investments, particularly primaries, are cross cycle. They're long-term investment horizons, long-term harvest periods. I think what we're always looking to source, regardless of where we are in the cycle, is best-in-class opportunities and partnerships that will continue to perform through cycles. And that's what we look to achieve. I think actually going back to what I mentioned as one of the very topical points around diligence is really the operational approach, the ability to continue to drive performance with headwinds. And that is something that I think is you'll hear from every LP probably during a diligence or during a relationship build, but that's becoming very, very important and is incredibly topical today.
How hard is it to reconcile market conditions with finding the right fund manager? Because sometimes you might have the perfect fund manager on paper, but then the market conditions don't lend themselves to that particular sector. Or
well, I think it depends on what your portfolio is. So when you zoom out, that's the individual GP investment in a primary, or when you think about secondary or co-invest, those are almost the micro. And then when you zoom out, you have to think about your overall portfolio and how that works together. And so this is where digital comes back into play and looking at tactical allocations. And so that doesn't mean necessarily dipping in and out of best-in-class managers because market conditions shift. It means thinking about how to make very, very small changes, tactical changes based on data to build an outperforming portfolio. And so that's a bit of the sky-high view, but I think it's one that's a quite important distinction as we're talking about GP selection, because that's very much the micro piece.
Carmela, did you have a question? If it hasn't already been answered.
Carmela, I write for Private Equity International, also a journalist, second heads up. I guess I'm curious to
Are
find
there
out
any GPs here, by the way?
how prepared or well equipped are the managers you've backed, to deal with challenges in the rising rate environment?
What?
In a rising rate environment. Rate environment, yeah.
I mean, if you look in our portfolio, I think we have an average entry EBITDA overall, which is below 7. So we have an average debt level, which is at entry at, I think, something like 2.3 or so. So if you pay 2 or 4% interest, it's not relevant. It's just not. I think it's relevant in the large cap segment, where you have debt levels of 7, 8, 9 times, so more than we pay for the company. So when you have lower entry valuation, the amount of interest what you pay is limited, and so I think the pressure both on the valuation side, the pressure on the availability of debt, and the importance of the debt financing and the interest rates, if you include the debt, mass and everything, this is obviously more in the large cap segment or in the upper mid market.
Thank you. Do we have any other questions? Yes, got one over there. Hang on.
Now a GP, please.
You'd like to introduce yourself?
Sorry to disappoint, I'm not a GP. Peter Wright from Campbell Lutyens. Just one quick question. When you're differentiating between making a large commitment or a small commitment, what are the differing points of conviction that you have between those two investments to kind of make you decide the ticket size of the commitment you're going to make?
So we're structured a little bit differently. We take very similar bites, with the exception of some segments of the market where the ecosystems are just too small. You need to have a feeder vehicle to diversify across a lot of different managers. But actually, when we look at portfolio construction, we look at very similar bites so that you're not overly diversifying or leaning in or out of anything too much. There's obviously variation in how you can think about that across general partners, but perhaps I'll pass it over to Rainer, having explained that for us.
So for us, it's very different, depending mainly on the added value which we receive from giving a big ticket. So let's say if I have a first-time fund and I take, let's say, 80% of the commitments, then typically I expect to get some sweetener for this. A lot of co-investments, for example, whatever. I will have veto rights for investments. So let's say the trade-off is more influence and some other sweeteners where I can optimize my overall performance with maybe other investments I do with this manager. And typically small tickets we do in established managers where we just do this also to get co-investments and other things.
Okay, do we have, yes, another question, great.
So my name is Christian, I'm an LP from Denmark. And I was trying to get your view on to build a good risk-adjusted private equity portfolio. How many commitments per year would you recommend, and the reasoning behind it? Are we talking 2, 3, 4, or are we talking 25 or 40 a year?
I think this depends on where you invest in. I mean, if you invest in a first-time manager who will have a portfolio of 4, and then you have maybe a mid-market buyout fund who is doing 20 investments in one fund. So you will have a immediately different diversification with one commitment already. So I think this depends on your strategy, where you want to invest in, what is your return expectation. So I could not give you advice there. But two is not a lot.
Maybe you have a number of portfolio companies when you.
So typically what we say is we need for one of our funds, fund of fund, we need diversification of around 50 portfolio companies. The problem of most fund of funds, they are completely over diversified. So this gives you indication, and you can make the math relatively easy by making a sample and then looking how many portfolio companies do you need to have a kind of a, so that the single write-off is not influencing your performance.
If we think about some of our more traditional mid-market buyout portfolios, it tends to be between 4 and 6 bites per year. But it's important, I think, if you go above that, to really be comfortable with the complexity that your portfolio will have in terms of tracking the underlying portfolio, really being on that journey with the managers, because that grows very quickly. And so to do more than that, you really have to have a tech solution in place.
Okay, we only have a few minutes left, so I think my final question to the panelists is if you had to give, say, 2 or 3 bits of advice to a fund manager on how to stand out from the crowd for the right reasons, what would they be? Sorry, I hadn't forewarned you about this question, but what sort of are the main things in your mind?
Having an attractive asset, which shows me that you can make 5 times money.
How about yourself? What are the key factors you look for in a GP?
Well, I'll go for the softer one, because I agree with Rainer there. That definitely would stand out. Look, I think knowing what you're doing and why you're doing it and how it fits into the broader market. I mean, that stands out. Because it will undoubtedly, if you're thinking about that, it will be different than other people. And differentiation is always going to probably get you that meeting with an LP. It may not get you an investment, but it will definitely get you the meeting and the FaceTime.
Some good advice there. Thank you, everyone, for listening in, and thanks to our panelists for their wise words.